Good morning, students. Welcome you all once again in the live virtual classes organized by Board of Studies of ICAI. Students, today we are going to discuss one of the important topic, which is accounting policies, changes in accounting estimates, and correction of errors. When I'm talking about errors, it is how to correct the errors. Good morning, Saurabh. Good morning, Gurram. Good morning, Priya, Miruna, Megha, Geet, Chitra, Sanjay. Good morning, everyone.
Morning, sir.
Good morning. Yes. Friends, when you look at the balance sheet, whether that balance sheet consists of all the accurate items or there are some sort of estimations are also sitting on the balance sheet. Tell me. There are estimated numbers also. There are few numbers which are on the basis of best estimate as well. For example, your PPE, your property, plant and equipment in the balance sheet. Is it actual number? Is it accurate number or is it a best estimate? Tell me. Megha is saying, no, sir, it is a best estimate. Why, Megha? Priya has explained, sir, PP number in the balance sheet is a best estimate because of depreciation. You are absolutely right. The PP number which is coming in the balance sheet is net block, gross block minus accumulated depreciation minus accumulated impairment losses. And this accumulated depreciation is nothing, it's an estimate. It's an estimate, right? So friends, this PP number is a best estimate number, right? Not an accurate number. Gross block is an accurate number. Depreciation is the best estimate because it is based on the estimated useful life of the asset. So that's how this net block become a best estimate. Friends, likewise, if I talk about provision for employee benefits, gratuity, leave encashment, is it an accurate number? No, it's a best estimate, right? If I talk about provision for asset retirement obligation, is it an accurate number? No, it is a best estimate. Inventory valuation. Inventory has to be valued at cost or NRV, whichever is lower. Whether net realizable value, if inventory is measured at NRV, net realizable value, is it a best estimate or is it an actual number? Tell me. Good morning, Bibhu. Good morning, Swaminathan.
Morning,
It's a
sir.
best, it's a
Good.
best estimate. Why? Because the formula of net realizable value is estimated selling price. The formula itself starts with estimated selling price minus estimated cost of completion minus estimated cost to sell. It's a best estimate. So one thing is very clear. In your balance sheet, there are some accurate number, actual number, and there are some number which are based on the best estimate, right? So it's a culmination of accurate number as well as best estimate. Okay, friends, now quickly, what are the component of the financial statement? What are the component of the financial statement? Now you guys are champion.
Yes, sir. Balance sheet, statement of profit and loss, statement of changes in equity,
Changes in
a
equity,
statement of
notes
cash
to
flow
account,
statement,
cash flow statement.
and notes to accounts.
Yes, and you're also saying the same thing, Saurav.
Same
Balance
thing.
sheet. Megha has also written balance sheet, statement of profit and loss, statement of changes in equity, statement of cash flows, and notes to accounts, right? We already discussed balance sheet in Ind AS 1 and Schedule 3, P&L in Ind AS 1 and Schedule 3, statement of changes in equities in Ind AS 1 and Schedule 3, statement of cash flow in the last class, operating activity, investing activity, financing activity, direct method, indirect method. We have covered those aspects. And notes to accounts. Friends, notes to accounts, few bit we have discussed in Schedule 3, in Ind AS 1 also. Tell me, what is the biggest component of the notes to accounts? Tell me. नोट्स टू अकाउंट्स में सबसे ज्यादा पेजेस किसके होते हैं?
Accounting policies.
Anyone else? Yes, accounting policies. Accounting policies took most of the pages in the notes to account. It is one of the most fattiest part of the notes to accounts. So friends, this standard tells us how to select an accounting policy, how to apply an accounting policy, and what is the treatment when there is a change in accounting policy, right? What is how to select an accounting policy, how to apply an accounting policy, and what is the treatment when there is a change in an accounting policy, right? So in days 8 teaches that how to select, apply, and what to do when there is a change in accounting policy. Sounds good? कौन सी 3 बातें बताता है इंडेस 8 नेहा? गुड मॉर्निंग. which three things Index 8 captures? How to select an accounting policy, how to apply an accounting policy, and what to do when there is a change in an accounting policy. Correct? Second, this standard also talks about what to do when there is a change in accounting estimate. Can you please tell me an example of change in accounting estimate?
The carrying value of the amount is based on the estimation of the future values. Change.
Useful life. Saminathan, very
useful life.
example. Useful life of the fixed asset, useful life of property, plant, and equipment. So, for example, there was a machinery. You have estimated the useful life of 10 years, but after 2 years, you realize that the remaining life should not be 8 years. It should be, let's say, 6 years. So you have changed your useful life. So that is a good example and the most simple example of change in estimate, accounting estimate, right? Because all these lives are example of change in estimate. This tower company, have you heard about Indus Towers Limited, Bharti Airtel, Vodafone Idea? All these telecom companies have towers, and they took the life of the tower as 20 years. But whether after 20 years the tower will fall down? Answer is no. At times, few towers need replacement even after 16, 17 years, and few towers are still standing and remaining tall even after 30 years, right? In Bharti Airtel balance sheet, there are so many towers which are still standing as it is even after 30 years. So 20 year is a kind of a estimated useful life, okay? So when the company is changing the useful life, it is a change in estimate. You are right, Megha, change in depreciation method, right? And so these are the few examples. These are the example of change in estimate. Okay, we'll come to this also. So Geet is also saying change in useful life, change in discounting rate for fair valuation. Change in discount rate is also an example of change in estimate. So friends, this part we will also cover in this standard. Correction of error, friends. This standard, the title is accounting policy, changes in accounting estimate and errors. This standard does not tell you how to make an error. This standard tell you how to correct an error, right? ये standard क्या बताता है? How to correct an error. Okay. So this standard talks about how to correct an error. Okay. Yes. So friends, we are going to discuss how to select, how to apply, and what to do when there is a change in accounting policy. Second, we are going to discuss the change in accounting estimate, the treatment in case of change in accounting estimate, and the treatment in case of correction of errors. Okay, these are the three aspects which we are going to cover in this particular standard. Ind AS 8 is very important from the examination perspective as well as from real life perspective. When you become a chartered accountant, when you go for an interview in the company, when you will start your life professional journey after qualifying a chartered accountant, this standards will still become very important. This standard will remain very relevant, right? So friends, if you see the series of the standard, we started our journey with the introduction of Ind AS. Then we cover Schedule 3, Division 2 to Schedule 3, which provides the format of the component of the financial statement. Then we have covered Ind AS 1, which gives you presentation of financial statement. Then we have covered Ind AS 7, statement of cash flows. And we have also covered conceptual framework for financial reporting. You remember that conceptual framework, that base, that fundamental. You remember that conceptual framework for financial reporting? Yes?
Yes, sir.
Okay.
Yes, sir.
Okay. So we covered those aspects. Now we are covering today, we are covering Ind AS 8 changes in accounting policies, accounting estimate and correction of errors, right? So we are learning only fundamental standard, which is related to your presentation of financial statement, which is related to when you are auditing the financial statement, what are the basic pillars, what are the fundamentals which you need to apply while preparation or while audit the financial statement. Okay. Friends, let's start the journey and first understood what is accounting policies. Friends, what is accounting policy? Accounting policy is your principles, right? A specific principle, your basis, conventions, rules and practices applied by the entity in preparation and presentation of financial statement. It's a principle, rule, basis, conventions, and practices applied by an entity, right? If you make a statement that on a daily basis, I used to wake up at 6 a.m., right? What is this statement? This is a principle. This is a rule. This is a practice which you are doing. Yes or no?
Yes, sir.
And if you will say that on a daily basis, I usually walk up between 6 to 7 a.m. So again, it's a policy, it's a rule, but that 6 to 7 a.m., what is that? That is an estimate, right? So what is your policy? Policy is your principle. For example, you are saying that PP is initially measured at cost. Subsequently, PP is stated at cost or revaluation model. Then PP is depreciated over the useful life of the asset. Tell me whether this entire statement is a policy or not. Whether this entire statement is an accounting policy or not. Geet is saying, yes, sir, it is a policy. What about you guys? Yes, it's a policy. PP is initially measured at cost. What is this? This is a statement, right? This statement is a principle. Yes, PP is initially measured at cost. You are talking about a principle. You are talking about a rule. Okay. Subsequently, PP is stated at cost of revaluation model. Again, you are talking about a principle, a rule, right? And then you are saying PP is depreciated over the useful life of the asset. You are again making a principle. You are again making a rule, right? But what is the estimate in this? So this is the practice, this is the rule, this is the principle. But how to apply that principle? PP is depreciated over the useful life. How to estimate the useful life? This useful life is an estimate. This useful life is an estimate. Okay. Have you got this? So what is a accounting policy? It's a specific principle, basis, convention, rules and practices applied by an entity in preparation and presentation of the financial statement, right? And while applying those accounting policies, you are using the accounting estimates also. Okay, for example, you will say that impairment loss, right? You will say that recoverable value. You will say that impairment loss occurred when your carrying value is higher than your recoverable value. What is this statement? This is a principle. This is a rule you are talking about. Then you are saying recoverable value is higher of fair value less cost to sell and value in use. Again, what is this statement? You are saying that in your accounting policy, you are saying that recoverable value is higher of fair value less cost to sell and value in use. It's an accounting policy, but the fair value less cost to sell and value in use, is it a policy or is it an estimate? This fair value less cost to sell and value in use, this is an estimate.
Estimate.
So how to compute the recoverable value, how to arrive at a fair value less cost to sell, how to arrive at a value in use, these are the estimate. But what is your value in use? It's a present value of future cash flows, present value of estimated cash flows, right? So for deriving a present value, you are estimating a discount rate. You are estimating the future cash flows. So how to compute the value in use? You are applying estimate. How to compute the fair value less cost to sell? You are again applying some estimate. It is not accurate number. It is an estimated number. It's a best estimate. Okay. You are making some assumptions, right? So you are saying that provision for gratuity has been measured as per the projected unit credit method, right? On the basis of actuarial valuation. What is this? This is an accounting policy. But this projected unit credit method, this actuarial valuation, what is that? That is an accounting. What is that? That is an accounting estimate.
Estimates.
That is an estimate. Because while doing an actuarial valuation, while applying a projected unit credit method, you are using some assumptions. For example, mortality rate. You understood the meaning of mortality rate? Mortality rate means death rate. Is it certain? Is it certain
No,
that
sir.
one
No,
out
sir.
of 1,000 people in this age bracket will always die? It's an estimate depending on the past precedent, right? Salary escalation, right? So you are factoring your salary escalation. Again, it's an estimate. You are estimating the discount rate. Again, it's an estimate. You are estimating the attrition rate. Again, it's an estimate, right? You're right, Geet. Incremental rate, discount rate, living rate, attrition rate, these are estimated by actuary. So have you guys understood the difference between accounting policy and accounting estimate? Accounting policy is something which tells you what to do. And accounting estimates are something which tells you how to do. How to do, or these are used to got some numbers, calculations, right? This helps in the accounting policy. Is that clear to everyone? You understood the meaning of accounting policies and accounting estimate, right? If there is an error in application of some estimate, for example, you have estimated the useful life of the fixed asset as, let's say, 20 years, but inadvertently, you applied that useful life while computing the depreciation as a 10 years. So what is this? Is it a policy issue? Is it an estimate issue, or is it an error?
Error, sir.
This is an error. You are absolutely right. This is an error, right? And you need to correct that error. Okay. So while so far we have understood in Ind AS 1, whenever there is a change in accounting policy, whenever there is a correction of error, what you will do? What you will do?
We will do the retrospective effect.
You will do the retrospective calculation and retrospective application, right? Application. You will restate your financial statement. What you will do? You will correct your current year number. You will restate your comparative year number, and you will also correct your opening balances of the comparative period. When you need to correct your opening balances of comparative period, you need to give the third balance sheet, restated balance sheet. Okay. What is that restated balance sheet? Opening of the comparative period balance sheet. In that case, three balance sheet will come: current year balance sheet, previous year restated balance sheet, and opening of the previous year restated balance sheet, right?
Sir, is that only that comparative period opening balance sheet, the third balance sheet is that alone is sufficient, or we need to go prior period as well? No.
No. Only opening of the comparative period balance sheet only, right?
But this, in terms of disclosure, sir?
In terms of disclosure also, right? I have shown you the ONGC balance sheet. Today I will also show the ONGC balance sheet, the real life balance sheet, so that you will be able to aware how these things are happening. Okay, right? So friends, doesn't matter if you are changing an accounting policy or correcting an error, and this has an impact of last 10 years. Still, what you will do? You will compute the impact of change in accounting policy, or compute the impact of correction of error from the date of error, or from the date from which the change is impacted, right, to the opening date of the comparative period. Cumulative impact you should take in the asset, liability, and equity of the opening balance sheet, right? Then when these opening balances are corrected, your previous year number balances are automatically corrected, and then your current year numbers are automatically corrected, because balance sheet numbers are brought forward and carried down, right? Okay, I will show you one real life example again. I have shown this example in Ind AS 1 also. Okay, yeah, let's move on. Friends, how to select and apply accounting policy. Now, before that, I have a question. If there is a change in accounting policy and if there is a correction of error which has an impact only from the previous year, the prior years are not impacted, the impact is only from the previous year, then what we should do? Whether we should change, whether we should provide the third balance sheet also.
It's not required, sir. Only it is a only with respect to the prior period only. No, the third balance sheet is not needed.
Opening balance sheet not required. What is the downside of opening? If you will give the opening balance sheet, whether it will be excess disclosure or it will be kind of a non-compliance.
It's a non-compliance actually.
Why?
Because it's not required. No, we need not disclose it. Otherwise, it will.
No. So Saminathan, if it is not required and you are giving that, then probably it's a over disclosure. Then why it is a non-compliance?
Okay.
So friends, it's a non-compliance, right? While he has given the right answer, but the reason is not that it is not required and hence it is given. It is, it is distracting the user of the financial statement, because when you look at the third balance sheet, what is the impression which will be in your mind? The impression will be probably this change in accounting policy or correction of error has an impact prior to the opening of the previous period, right? It means this impact is from last 4, 5, 6, 7, 8, 10 years. Okay, probably. But when there is no third balance sheet, and of course there is a restatement of the previous period, the first impression as a chartered accountant, as a user of the financial statement, what will come to your mind that, oh, this change in policy or correction of error has an impact only from the last year. Means this is something which needs to be corrected only from the last year, not from the prior to the last year. Is that okay? Is that okay? So that's why it become a non-compliance. Okay, because it is changing the users, it is changing the decision-making capacity of the user of the financial statement. It is impacting how the users will think about. Is that clear, guys?
Yes, sir. Clear, sir.
Okay. So friends, how to select and apply an accounting policies. The first part, you remember, I told you this standard talks about how to select and apply an accounting policies. Okay. For example, Chitra. Let's say Chitra is a chartered accountant. Okay. She joined a company and her CFO told her that, Chitra, this time, for the first time, what we have done, we have implemented SAP, ERP. Okay. We have implemented ERP and we have incurred a huge cost on the implementation of ERP. So you need to draft an accounting policy. So Chitra told, sir, it is an intangible asset. CFO said, yes, Chitra, that is why you need to draft an accounting policy on this intangible asset. What Chitra will do? While drafting an accounting policy, what is the guidance which Chitra will refer?
Sir, first she will check is there any accounting standards specifically provided the guidance for that particular items.
Yes.
We have Ind AS.
Yes. So first she will check, is there any specific Ind AS which talks about intangible asset? She will just start checking, and since she is a chartered accountant, she knows that, oh yes, Ind AS 38 is there. So what she will do? She will open Ind AS 38, or she is already expert in Ind AS 38, become a chartered accountant, being a chartered accountant. So she will draft an accounting policy using Ind AS 38, that how to recognize, how to measure, how to present, how to disclose, right? So this intangible asset has to be measured at cost. Subsequently, it has to be measured at cost of revaluation model. At the end of the balance sheet reporting date, this intangible asset has to be amortized every year on the basis of the estimated useful life. Then this intangible asset is also subject to impairment. Okay. So she will draft an accounting policy using the guidance from Ind AS 38. What happens if Ind AS 38 is not there? So Chitra has to prepare an accounting policy on intangible asset, but she has not found any specific standard on intangible asset. What she will do then? Then, friends, Ind AS 38 says that if there is no specific accounting policy, then you have to apply your judgment. If no specific Ind AS is available, you need to apply your judgment. Judgment should be applied to develop an accounting policy which result in relevant and reliable information. You remember in the conceptual framework we talked about the information has to be relevant and faithful representation.
Yes,
Yes,
sir.
sir.
ये दो वर्ड याद है ना आपको हर जगह पे, relevant
Yes,
and faithful representation. So friends, Chitra is not getting any Ind AS on intangible asset, assuming, right? Then she again went back to Ind AS 8. Ind AS 8 told her that not to worry. If no specific Ind AS is available, you need to apply the judgment. What is meant by judgment? High Court, Supreme. You don't have similar Ind AS on intangible asset. Do you have a standard on tangible asset? For example, yes, I have a standard on Ind AS 16 PPE and develop your accounting policy. Friends, I will give you a real life example on this. Friends, there was a merger between Bharti Infratel Limited and Indus Towers Limited of a joint arrangement. What it becomes? It becomes a formation of a joint arrangement between Bharti Airtel and Vodafone Limited. ये एक जॉइंट अरेंजमेंट बन गया. किसके बीच का जॉइंट अरेंजमेंट बन गया? भारती एयरटेल एंड वोडाफोन लिमिटेड के बीच का, राइट? एंड फ्रेंड्स, then we had to do the accounting of this. Okay, we had to do the accounting of formation. Then we went to Ind AS 103. There is only, and what is that standard? Ind AS 103, which talks about business combination. And when we entered into it, is not applicable to formation of joint arrangement. Ind AS 103 is not applicable to formation of joint arrangement. What to do then? Priya, what to do then? We need to develop an accounting policy. What is the use of accounting policy? You apply accounting policy for accounting and reporting, right? Users were able to know that how you are doing the accounting and reporting of a particular item. What to do now? Ind AS 103 scopes out. Ind AS 103 scopes out that. Then what we have done? We went to again Ind AS 8. We told Ind AS 8 that Mr. Ind AS 8, we don't have the specific Ind AS on the formation of the joint arrangement. Accounting in case of formation of the joint arrangement, we don't have Ind AS, any Ind AS. Then Ind AS 8, then go to the similar Ind AS, and it says that okay, you don't have a standard on the acquisition of joint arrangement, formation of joint arrangement, but do you have a standard on the acquisition and merger? Do you have the standard on acquisition of subsidiary? We said yes. Which standard? Ind AS 103. So Ind AS 8 says that not to worry. Okay, if no specific Ind AS, then apply similar Ind AS. Again, we went back to Ind AS 103. We applied Ind AS 103, but why not as a specific Ind AS, as a similar Ind AS? Have you understood? जॉइंट अरेंजमेंट की एक्विजिशन पे स्टैंडर्ड नहीं है, पर क्या मर्जर एक्विजिशन पे कोई स्टैंडर्ड है? यस, Ind AS 103 है. So we as a similar Ind AS. Have you understood this or you haven't understood this? The real life example.
Yes, sir. Understood, sir. Thank you, sir.
Then you need to apply the similar Ind AS. Okay. If there is no similar Ind AS, then you remember I told you no Ind AS. The purpose of the framework is to help you in drafting Ind AS, to help you in interpretation of Ind AS to help you with financial reporting. And then you need to look at the definition, recognition criteria, measurement concept for asset, liability, income, and expenses in the framework, right? Now we are champion in the conceptual framework for financial reporting. Sir, in the similar Ind AS, C hasn't found. C has also gone back to the conceptual framework, but C hasn't got the clarity, for example. Then the third guidance standard says that has come.
It is a converged from IFRS. We can.
It is converged from IFRS. It is the converged version of IFRS. It is in IFRS because International Accounting Standard Board do a lot of research. It took the inputs from all across the world. But IFRS is not confined to India. It is confined to the entire world. Okay. So that is why they are so fast about making changes. So Ind AS 8 says that, dear Chitra, if there is no specific Ind AS, then you have to apply a judgment. You have to go IFRS. Then the most recent pronouncement issued by International Accounting Standard Board means IFRS. Okay. So if you will not get the answer from IFRS, then the other standard setting bodies, other accounting literature, for example, US GAAP. And if you will not get the answer from US GAAP also, then you will change your job, or what you will do? Then you will look at the industry practices. Is there any industry practices? Because the sectoral companies must be there. Then you will need to look at those accounting policies which is industry accepted. If not, then of course draft your own accounting policy, apply it consistently. Okay, or what you will do, you will give this to the Big Four or some expert firms. So what those expert firm will do, they will do the same task. Yes or no? Is that clear? So friends, how to select and apply an accounting policies? Number one, you need to refer the specific accounting policy. If there is no specific accounting policy, then you need to apply the judgment. While applying the judgment, you need to follow few guidance in the descending order. Number one, if no specific Ind AS, then similar Ind AS. Then conceptual framework. Then IFRS. Then other standards from other countries. Then industry practices. So these are the guidances which you need to follow, which you need to refer for development of your own accounting policies. Is that clear? Friends, at times, if the theoretical question will come from this standard, it will ask you how to select and apply an accounting policy. Then you have to be very much clear. Will you be clear now? Do you remember this or not?
Yes, sir. Very much clear, sir. Remember
very
it.
much clear. Chitra will never forget because this example was on her. So she will never forget this topic, this concept, right? Okay. Yes. Now, friends, we understood that how to select and apply an accounting policy. Now, how to change or when to change an accounting policy. कब बदलेंगे accounting policy को? Friends, standard says that a company, an entity, this entity needs to select and apply its accounting policy consistently from one period to another period. Consistently means the entity should not change the accounting policy until and unless a change is required by an Ind AS. Ind AS ही change हो गया तो accounting policy change करेंगे या नहीं करेंगे? या विभू, नेहा, अगर Ind AS ही चेंज हो गया तो क्या अकाउंटिंग पॉलिसी चेंज करेंगे या नहीं करेंगे?
करेंगे सर.
करेंगे सर.
करेंगे. We will change. In case Ind AS is changed or Ind AS got amended, new Ind AS has come, then of course you will change your accounting policy, right? When an entity shall select and apply its accounting policy consistently until and unless a change is required by an Ind AS, right? For example, the classic example is April 2019. Ind AS 116 on leases notified on 30th March 2019. Okay. This standard was applicable from 1st April 2019. Prior to Ind AS 116, Ind AS 17 on leases was applicable. And Ind AS 17 was very much similar with accounting standard 19. Right. But when Ind AS 116 came, and Ind AS 116 told that, friends, whenever there is a leases, you have to capitalize right of use asset and lease liability, just like a finance lease. So the entire accounting from the lessee side has been changed in Ind AS 116. So whether the companies have changed or not, of course, everybody has changed their accounting policy in case of leases, right? In case of leases. So in that case, whenever there is an amendment in Ind AS, whenever there is a change in Ind AS, whenever there is a new Ind AS, of course, you have to change your accounting policy also. Right? Or when the change result in the financial statement providing more reliable and more relevant information, right? More relevant and more reliable information about the effect of transaction, other event or condition on the entity's financial position, financial performance, or cash flows. For example, the entity has opted for a revaluation model. You understand cost model, revaluation model? आपको पता है ना? Cost model,
Yes.
revaluation model. Yeah.
Yes, sir. On PPE.
On PP, yes, you have learned those model in accounting standard 10, CA Inter. ये तो सबको याद होगा.
Yes, sir.
Yes. So friends, this cost model, revaluation model, the company has opted for revaluation model. But at the year end, the market is so much volatile, right? For example, on 25th March, the price of the property was 90 lakhs. On 28th March, it become 95 lakhs. On 31st March, it become 86 lakhs. On 5th April, the price becomes 99 lakhs. So the price is highly volatile. The price curve is like this only, right? This is the price curve. Friends, in this case, tell me whether on the reporting date, revaluation model will reflect the right picture, or we should measure it at cost model. Friends, we have to measure it at cost model. Why? Because the market value is not reflecting a right value. Probably on 31st March, the price of the property is 85 lakhs. But after 6 days, it becomes 99 lakhs. After 5 days, it becomes 90 lakhs, right? So the market is highly volatile, ranging from negative to positive. Negative to positive means below cost to above cost. So in that case, the change in accounting policy moving from revaluation model to cost model will reflect the right picture that yes, this is the cost price of this asset, okay, on the reporting date. So if your change in accounting policy is reflecting more reliable and more relevant information, then of course you can change your accounting policy. Have you understood? Accounting policies has to be applied consistently until and unless a change is required by an Ind AS or it represents the faithful and reliable information. Is that clear to everyone, friends? Is that clear to everyone? Yes or no?
Yes, sir.
Yes, sir.
Yes, sir.
Clear, sir.
Okay, perfect. Yes. Friends, now exceptions. When a change is not treated as a change in accounting policy. Sir, क्या फायदा होगा? मतलब why you are saying when there is a change but it will not be treated as a change in accounting policy, तो उससे फायदा क्या होगा? When there is a change in accounting policy, what is the treatment?
So we have to give the retrospective effect and its application.
We have to give the retrospective effect and retrospective application. We have to restate comparative. We have to give the opening balance sheet and we have to provide some disclosures. Yes, this is what you are saying. But
Yes, sir.
when there is a change, but it will not be treated as a change in accounting policy, then whatever you have to do in the current year only. No restatement, no third balance sheet, no disclosures. Correct? So friends, standard says that if change is due to different economic condition, or new event or condition. For example, the company was using a building for its own, business premises. So what is the nature of this building? Whether this building is a property, plant and equipment or investment property. This building is a PPE, property, plant and equipment. This building is covered under Ind AS 16. It's a PPE. And Ind AS 16 talks about PPE. Okay. The company get into some cash crisis. The company has a liquidity problem. The company has let out this building and shifted to a smaller premises, shifted to a smaller rental premises. So this was the own building of the company. The company was running its own office, but now this company has shifted from its own office. The company has given this building on rent. So now when the company had changed the business model of this building, this building is only held for the rental, earning rental. This building is not used for the business. This building is used for earning rental. So still, is it a PPE? Standard says that no, it is an investment property. And investment property standard is Ind AS 40, right? So when there is a change in business model, the accounting policy will also change. Whenever there is a change in business model, the accounting policy will also change. So whenever there is a change in accounting policy to hai, but is it treated as a change in accounting policy as per Ind AS 8?
No, sir.
Why no?
No, sir.
Change in substance of the transaction.
Change in substance of the transaction, because there is a change in business model, there is a change in substance of the transaction, there is a new event or condition. That is why it will be treated as a not a change in accounting policy. It is not a change in accounting policy. Okay, because the business model has changed, the substance of the transaction is changed. Now you are applying Ind AS 40 accounting policy. Earlier you were applying Ind AS 16 accounting policy. So whatever change you have to make in the current year. Previously immaterial effect. So when Chitra joined a company, so she got an assignment of preparation of accounting policy for ERP, right? So Chitra asked, sir, I have seen that in the last year it was Tally software. So where is the Tally in the balance sheet? So CFO told Chitra, we are the $1 million company. We are the thousands of crores of the company. And Tally software we have purchased at 1 lakh rupee. Right? We are presenting our number in millions. So what is 1 lakh? It is 0.1 million. Right? So we even don't present decimals, and the Tally software was 0.1 million. So what we have done, it was an immaterial number and we have charged off it to the P&L. We haven't taken it to our fixed asset register, our intangible asset register, and we have charged off it to the P&L. So whether Tally software was intangible asset? Whether Tally software is intangible asset? Yes or no?
Yes, sir.
It's intangible, but it is immaterial items.
No. So my question is it an intangible asset? Yes, it is an intangible asset. If the company is not $1 million company, if the company is a small company, yes, it has to be capitalized. It is an intangible asset. But this company has charge of this intangible asset into the P&L. This company has not capitalized. Whether this company is right? Can the company do so? Yes, the company can do so because of the materiality factor. Right? Since the amount was immaterial, it is not impacting the decision-making capacity of the user of the financial statement. It is not changing the number anymore, right? And hence, it is okay. Because the numbers are immaterial. But now, the company is investing or purchasing another intangible asset, which is for 5 crore rupees. So now, Chitra, can this 5 crore rupees of ERP can be routed through P&L? Can be charged off to the P&L? Answer is no. It should not be. It should not be. So earlier, the intangible asset which the company has purchased, they have charged off it to P&L. But now intangible asset which the company is purchasing, they are not charging it off to the P&L. So friends, is it a change in accounting policy?
No, sir.
Why no?
Because the earlier things, the previously the immaterial effect, the 1 lakh rupees is immaterial. Now it is a 5 crore is a material. So we will be giving the prospective effect, not the retrospective effect.
Yes. So the only thing is this is a change. Yes, this is a change in policy, but it will not be treated as a change in policy because the earlier treatment was on account of immateriality, right? Earlier, the amount was not material and hence the different accounting policy was applied. A different accounting treatment was applied, but now it is a material and hence the correct accounting policy should be applied. So just on the materiality background, right? On the materiality background, it is not a change in accounting policy. So have you understood this? So in these two situations, the change will not be treated as a change in accounting policy. If the change is not treated as a change in accounting policy, in that case, you are not required to do any restatement, any disclosure. Whatever is the impact, take it into the current year. That's all. So friends, we understood how to select an accounting policy, how to apply an accounting policy, when to change an accounting policy, and when a change is not treated as a change in accounting policy. Is it crystal clear to everybody? Yeah?
Yes, sir.
Yes, sir.
Crystal clear?
Crystal clear, sir.
Clear in mind or clear from mind?
Clear in mind, sir.
I need a confirmation from everybody. Megha has confirmed, Miruna has confirmed, Saminathan has confirmed, Saurav has confirmed. I need a confirmation from everybody. Neha has confirmed, okay? Today example was on Chitra only. So she has also confirmed.
Even though she is not confirmed, it's understood that she confirmed.
Yeah. So now, how to apply a change in an accounting policy, right? Accounting treatment. Friends, whenever there is a change in accounting policy, you need to look at whether the change is due to new Ind AS. Whether the change is due to new Ind AS. We heard na? We learned na that the accounting policy has to apply consistently, but it can be changed in two circumstances. Number one, when there is a new Ind AS or when there is a change required by Ind AS, or when the change reflects the relevant and reliable information. Okay. So friends, when the change is due to new Ind AS, so after notification of Ind AS in India in 2015, after the original notification, there was a new standard on revenue came and there was a new standard on leases came. Okay. So if the change in accounting policy is due to new Ind AS, you need to look at whether the new Ind AS has a transitional provisions. What is meant by transition provision? Transition provision means when you are moving from old Ind AS to new Ind AS, whether it helps you, it facilitates you that how to make a change, right? And in all the new Ind AS, there is a transition provision which says that you can do a prospective application also. Means since it is a change in accounting policy, Ind AS is changing, right? And of course, you need to apply the retrospective impact. But all the new Ind AS are also giving you the prospective option also. When the lease standard came, there was a choice. If you want to apply retrospective, you can apply retrospective. But if you want to apply prospective, you can apply prospective application also. Means no restatement of the previous year number, no third balance sheet, no the last disclosures. You can do it from the current year only, right? You can do it from the current year only. So this transition provision is given in the new Ind AS, which gives you a choice of retrospective restatement or prospective application, right? So if the new Ind AS gives you a transition provision, please apply the transition provision as per that Ind AS. Or the new Ind AS does not apply you the transition provision, or you are voluntarily changing your accounting policy. In both these cases, what you will do, you have to apply the change in accounting policy retrospectively. Retrospectively means you have to restate your comparative year numbers. You have to give the third balance sheet and you have to give some disclosures. Friends, should I show you the real life example? Should I show you the real life example? दिखाऊं या
Yes,
छोड़
please,
दूं?
sir.
दिखाऊं? Okay.
Yes, please.
You want to see that real life example? Okay, let me show you the real life example. Just allow me a minute. I'm opening the ONGC balance sheet, which I have shown you in Ind AS 1 also. And you will love that balance sheet of Maharatan company. ONGC is a big public sector company, government company, listed company. Okay. Please let me know if the ONGC. Yes, very good. Friends, let me take you to the balance sheet first. Okay. Friends, ONGC adopted Ind AS from financial year 16-17, the mandatory application. It's a big listed company. Ind AS mandatorily applicable. Friends, can you see the balance sheet of 31st March 20? Current year 31st March 20, previous year 31st March 19. What is the previous period? 18-19. What is the opening date of the previous period? 1st April 2018. 1st April 2018. Friends, 1st April 2018. There is a third balance sheet. Are you able to see this third balance sheet?
Yes,
Yeah?
sir.
Yes, sir.
Third,
Yes, sir.
third balance sheet. And can you see some star mark in the third balance sheet and the previous balance sheet?
Yes, sir.
What is the
2018
meaning?
star.
Restated. Yes, you can see this star mark. So this 1st April 2018 balance sheet is nothing. It's a 31st March 18 balance sheet. But of course, the corrected balance sheet. So I have shown you the third balance sheet, and third one is the opening of the comparative period balance sheet.
It also means same as restated, sir.
Restated, refer note number 54. Then statement of changes in equity. In statement of changes in equity, you can see there is a effect of change in accounting policy. What does it mean? It means this company has changed an accounting policy, right? So balance as at 31st March 18, there is a change in effect of change in accounting policy. Then the opening of the comparative period balance sheet 1st April 2018. So 31st March 18 number become 1st April 18 number with a impact of change in accounting policy. Then statement of cash flow current year.
Yes.
Shall I take you to the note number 54?
Yes, sir.
Yes. Yes, sir.
Disclosure as per Ind AS 8 accounting in accordance with Ind AS 8 and Ind AS 31st March 19 and loss for the year ended 31st March 19 for the reason as stated below. Grant, right? I'm not telling you that what change they have done. I mean to say what. So what was the previously reported number? Every adjustment through notes, each and every explanation through notes, right? Then reconciliation of P&L, लास्ट ईयर P&L, नॉट करंट ईयर. करंट ईयर का क्या रिकंसिलेशन देंगे? नंबर ही पहली बार दे रहे हैं, बट लास्ट ईयर के नंबर पहले से पब्लिश हो चुके हैं. सो प्रीवियस ईयर पर शेयर. Then there is a reconciliation of statement of cash flows. And again, what was the previously reported, what is adjustment and what is restated. And all these notes explaining the reconciliation, right? And all the to everyone, my dear friends.
Yes, sir.
Have you found it useful? with the real life notes which you have seen from your Ind AS 8?
Very useful, sir.
What about others? I want to hear from others also. Saminathan is very frequent in responding, answering. So I want everybody to do like that. What about others? Will not engage with you. They will always engage with you. Are you enjoying my session?
Yes, sir.
Yes, sir. 200%.
Okay. Yes. Are you able to understand also? Great. Friends, the only thing is in this virtual, so now the world is living in the virtual world, right? Doesn't matter it is ICAI sessions or other sessions. So you need to be cope up and you need to understand, you need to, you need to also work hard to make difficulties will show you the real life example so that it will get printed in your mind. You will not be confused. How this retrospective restatement, what kind of comparative balance sheet restated means the adjustment has been done. Opening balances corrected means opening of the comparative period adjustment has been done, right? So you will be able to appreciate those provisions. Okay. So friends, we understood the how to select and apply an accounting policy. We understood when to change an accounting policy. We understood what is not considered as a change in accounting policy. What are the disclosures in case of change in accounting policy? You need to give the reconciliation of balance sheet item, P&L items, earnings per share, statement of cash flows. Okay. And you need to also talk about what has changed, what is the nature of the change, okay, and what is the impact. All those things you need to disclose. Friends, for example, this change in accounting policy has the records in the godown, accounting records in the godown for the last 5-7 years. And due to fire, all those records have burned. All those records have destroyed. So now this of last 10 years. So what to do now? Standard says that whenever you are changing your accounting policy, you have to take the change. You have to take the impact right from the beginning from where this change is impacted. But if you find it impracticable, if you find it impossible, impracticable, then please apply the change from where you can apply the change. Means not from the last 10 years. If you have the records from the last 4 years, please do that. Please do that. But you have to give the disclosure in the notes retrospectively. You need to explain why and from which date you have done this and how you have done this. You have to give the disclosure so that the user will be able to understand that you haven't take it from the day one from where it was supposed to be applied. You changes due to any new Ind AS, then you have to give the title of Ind AS and you have to provide the what are the transition provision and what will the future impact. Any doubt up to this level? Any doubt?
No, sir.
No, sir. But that Companies Act and the other act also, that the retention of the record is talks about 8 years. Suppose
Yes.
if it is if it is for retrospective, if the company starts with
Right. You are absolutely right. Because the statutory regulation also talks about retaining the records for 8 years. And if the accounting policy changes the impact of last 20 years, so how will you apply that change? Then you have to say that we have applied the change only from the last 8 years because as per the statutory requirement, the company is required to retain the records for the last 8 years. And since we have the data and the records for last 8 years, and hence we have applied from the last 8 years. Okay. Friends, now the concept is material accounting policy. You must have seen in your notes to accounts the concept of significant accounting policy. But in Ind AS, the word significant has been changed to the material accounting policy. And what is meant by material accounting policy? You must have seen, people are thinking this accounting policy just like a copy-paste exercise. Yes or no? In your notes to accounts, if you have to prepare a financial statement, you have to take some other company's financial statement. You will copy the notes to accounts and you will paste the notes to accounts. In the accounting, I'm talking about accounting policy. Friends, Many companies were doing that. For example, the company is thousands and crores of a company. And this company has purchased a tally software. Friends, is it material? The tally software is a material item for the thousands of crores of a company, $1 million company?
No, sir.
It is not material. It is not material. But the company is giving an accounting policy of intangible asset for 6-7 lines, for half pages. Does it justify to give a half-page accounting policy for an immaterial item? Just think practically. And why this change has come, because the change has come globally in IFRS. And that is why in India we took this change.
Only significant accounting policies we need to give it.
Where the items are material, there is no concept of significant. The concept is materiality, right? Where the item is material, you have to give the accounting policy, right? You have to give the accounting policy. So the point is, what was happening earlier, people were giving accounting policy for everything, right? Doesn't matter if it's a penny item, people were giving accounting policy for everything. So, and what it was leading to, your accounting policy section becomes very bulky in the annual report, in the financial statement. So the user of the financial statement, investor, lender, where they need to focus, they were not able to focus because they have lot to read. That is why the concept of material accounting policy has come, and it has says that if the transaction or other event or condition is material on account of size, nature, you doesn't need to give those immaterial accounting policy, right? So few guidances has been given, which says that if it is a material accounting policy, you need to disclose those material accounting policy. Okay. Then only material accounting policy disclosure is required. Otherwise, no. Clear? Shall I move forward? Okay. Friends, whether it is clear to everybody, is it clear to everyone? Yes. Now, change in accounting estimate. Very simple. We have talked about this. Accounting estimates are the monetary amounts. What is the accounting estimate? It's the monetary amount in the financial statement which are subject to measurement uncertainty. Discount rate, provision for the discount rate, attrition rate, salary escalation rate, useful life, whether these are subject to measurement uncertainty or not. These are subject to measurement uncertainty, right? These are subject to measurement uncertainty. So these measurement will change. These measurement may change. Okay. So what is an accounting estimate? The word is estimate. These are the monetary amount in the financial statement, which are always subject to measurement uncertainty. Example is provision for doubtful debt, useful life, residual value of PPE, provision for warranty, inventory impairment on inventory, fair value of financial assets or liability, discount rate, value in use. These are the examples of change in accounting estimate. Standard says that if you are not clear whether a change in policy or change in estimate, you have to take that change as a change in estimate. Depreciation method, is it a change in policy or change in estimate?
Estimate.
Depreciation method change is a change in accounting estimate. Okay. So standard says that if you are not clear, is it a change in estimate or change in policy? Nothing is written in the standard. Then of course you can take this as a change in estimate. Friends, if there is a change in estimate, will you apply retrospective or will you apply prospective?
Prospective effect and application.
You have to apply prospective, not retrospective. You have to apply prospective. Means, for example, you have purchased your fixed asset at 1 lakh rupee. The life was 10 years. What is the first year depreciation? फर्स्ट ईयर का डेप्रिसिएशन क्या होगा? 1 लाख रुपी वैल्यू है, 10 ईयर की लाइफ है. व्हाट इज द डेप्रिसिएशन?
10,000.
10,000. As simple as that, 10,000 rupees. Okay. Next year, what is the remaining life?
9 years.
9 years. But, and what is the WDV? What is the WDV? Opening at the end of year, what is the WDV?
90,000.
90,000 is the WDV. Remaining life is 9 years. Okay. Friends, so when the company reviewing the useful life, the company has found that the remaining life is not 9 years, the remaining life is 5 years. Now, what is the depreciation in the second year? 18,000. 90,000 divided by 5. 18,000. So whether this change has to be taken in the last year also? 10,000 in the current year of depreciation is 18,000. So whenever there is a change in accounting estimate, it has to be applied prospectively. Means you have to take the impact in the year of change. And you need to disclose. What is the impact in the year of change and what will be the impact in the future year. For example, you need to disclose in the current year, my depreciation is increased by 8,000. My depreciation as per the older rate, should be 10,000. But my depreciation as per the revised life is 18,000. And in the next year, of course, it will be 18,000. So you have to give the impact in the period of the change and impact in the future period also. Is that clear?
Yes, sir.
Okay. So friends, again, same disclosure is there. Whenever there is a change in estimate, you have to give the impact of the change in the current period and in the next period. Okay. Now, coming to the errors, accounting estimate is quite simple. It's a prospective, completely prospective, no restatement, no third balance sheet, nothing. Friends, errors. What is the meaning of error? Whether error only includes mistake or it also includes fraud.
Fraud also is an error, sir.
Friends, when I ask this question, 90% of the student and chartered accountant says that error does not include fraud, right? Why? Because they step into the shoes of a regulator. From a student or from a chartered accountant, what they started doing, they step into the shoes of a regulator. They think like a regulator. How come this fraud becomes an error? Friends, you are a chartered accountant. If there is a mistake or there is a fraud in the financial statement, what you as a professional will do? You will correct your financial statement. आप तो ठीक ही करोगे ना?
Yes, sir, we will correct it.
So, for example, गलती से अगर किसी से गलती से कोई एक्सपेंस रिकॉर्ड होना रह गया गलती से, it is a mistake, it was unintentional. So what you will do? You will correct. अगर किसी ने जानबूझकर intentionally, if somebody has not recorded the expense, was that mistake? If somebody has done it intentionally, it is a fraud, na? It is a fraud. It is a fraud. So, but as a professional, as a chartered accountant, आप क्या करोगे? Somebody is intentionally not recorded the expense. You will record the expense. You will apply Ind AS 8. You will correct your comparative number in your current year. You will correct your comparative, restate your comparative, give the third balance sheet, provide all the disclosure and reconciliation. Yes or no? The fraud doesn't matter. You have to apply Ind AS 8 and you have to apply the provisions of correction of errors. Right? So error includes intentional as well as unintentional mistakes. Okay. So friends, what is the definition of an error? Prior period error are omissions and misstatement. Omission is a mistake. Misstatement is a fraud. In the entity's financial statement for one or more prior period arising from a failure to use, mistake, or misuse, fraud, of reliable information that was available when the financial statement for those periods were approved for issue, right? and it can reasonably be expected to have been obtained and corrected. This is the definition of prior period error. What is a prior period error? It is a omission or misstatement. It is a failure to use or misuse of the reliable information which was available on the reporting date and even when the financial statement are approved. Okay. Example of error are mathematical mistake, mistake in applying accounting policies, oversight, misinterpretation of fact, frauds. These are the example of correction of error. Now, what is the accounting treatment of correction of error? Same accounting treatment of change in accounting policy. Same accounting, same treatment as a change in accounting policy. Yes or no? What you will do? If
Yes,
you
sir.
will get an error, what you will do?
Yeah, we will give the retrospective effect as well as its application also will do it.
Yes. But if the error only pertains to the last year, only comparative year, then
Then
In
only
that case,
comparative balance sheet.
we will not give the opening third balance. We will not give, sir.
we will not give the opening of the comparative period balance sheet. If the error pertains to the past year only, only last year comparative number needs to be restated. Only balance sheet, P&L, cash flow of the comparative year needs to be, the reconciliation needs to be given in the notes to accounts, right? Third period, opening of the comparative period should not be given. Okay.
Sir, I have one doubt. That error meaning it's provided omission from our misstatement. Obscuring also is error, sir. That is what we studied in
So
Ind AS 1.
generally, Saminathan, obscuring happens in the notes to accounts. Okay. So omission and misstatement can happen in the balance sheet, P&L, cash flow also. But obscuring means spreading the information. Right?
Yeah,
You are,
yes, sir.
it's not like you are not giving the information. You are giving the information, but you have scattered the information in such a manner that the information will lose its gravity.
That other material item also is impacting. No, when there is a material item, it is a misplaced with here and there, and the meaning is not there. Then also it's a tantamount to error, right?
Yeah, you are right. But the only thing is, if there is only impact in the notes to accounts, you will correct your notes to accounts, right? In that case, third balance sheet concept does not arise because there is a, because if it's a matter of notes to accounts which is not impacting your balance sheet, contingent liability. Let's say you have forgot to record in contingent liability. Record means disclose. Then what to do? Contingent liability is not a balance sheet item, na? So in that case, you will only take this, I think, into disclosure. वो तो बैलेंस शीट में पहले भी नहीं था और अभी भी नहीं आना. Are you getting me?
Yes, sir.
Yeah. So that's the thing. Now again, the question is, let's say you find out that there was an error which was happened 15 years ago, but you don't have the record, and you have to do the retrospective application. So tell me, how will you do this retrospective application?
Then in this case, it is impracticable. We will give the fact of that why we are not unable to give the retrospective effect. From
examination, you will get a question. You will get a question that, the entity has made an error in the financial statement and it was detected by some forensic teams and, but they don't have the records because this pertains to the 15 years back, but they have the records from the last 8 years and the accountant can compute the impact of the error only for the last 8 years. Then of course, standard allows you, it says that from wherever it is possible and practicable, please correct the error from that period only. Correct the error from that period only. Right? Is that clear? Okay. But you need to give this disclosure in the which is of disclosures in accounting policy. Same treatment which I have shown you in ONGC balance sheet. Friends, this is a summary view. And what is the summary view? Accounting policies, principle, basis, convention, rules, and practices. It has to be applied retrospectively until and unless something is specified in the standard. For example, in day 16, when you read. So can you please keep on mute? Friends, can you please keep on mute? For example, when you revaluation model or revaluation model to cost model, then the third balance sheet is not applicable. It is a prospective application, right? The third balance sheet period concept is not applicable. So example, creation of right to use asset and leasehold obligation at present value of lease rental over the lease term. What is change in accounting estimate? Amount, patterns, monetary amount, which is subject to measurement uncertainty, which is due to new information or development. It has to be applied prospectively. Estimating discount rate for calculating present value is retrospectively if it is a material error. If it is an immaterial error, it is not an error from the accounting perspective. For example, error in calculation of right to use asset and leasehold obligation, or forgot to account for escalation in the lease period. Okay, this is the summary view. This is the summarized view of accounting policy, change in accounting estimate, and correction of errors. Friends, talking about the difference between Ind AS and accounting standard, Ind AS 8 talks about accounting policy, change in estimate and error. Accounting standard 5 talks about net profit or loss for the period, prior period item, and changes in accounting policy. Change in accounting policy requires retrospective application, right? And retrospective application and retrospective calculation. But in accounting standard, it requires retrospective calculation but prospective application. In AS, it was no retrospective application. It was prospective application. But in IGAP, accounting standard, retrospective calculation but prospective application only in the current year. There are very detailed disclosure in Ind AS, comparatively less disclosure in accounting standard, right? This was all about Ind AS. This was all about Ind AS 8, right? So what we have learned today, we have learned today accounting policy, define what is accounting policy, how to select an accounting policy, how to apply an accounting policy, what is a change in accounting policy, what we have also discussed, how to select and apply an accounting policy. Then when to change an accounting policy. Change an accounting policy. When a change is not, I hope my Excel is visible, when a change is not treated
Yes, sir. Excel visible, sir.
as a change in accounting policy. And what is the treatment of change in accounting policies, right? What is the treatment? Retrospective calculation and retrospective application. Then what is an accounting estimate? What is the treatment of change in accounting estimate? Prospective calculation and prospective application. Yes or no? What is an error? Whether error includes only mistake or it also includes fraud, what is the treatment of correction of error? Again, retrospective calculation, retrospective application. Example, an asset is impaired if recoverable amount is lower than carrying amount. The company has estimated the discount rate of 10%, but it was inadvertently applied at 1% by the accountant while doing value in use calculation. Identified in above the accounting policy, accounting estimate, and correction of error. Friends, an asset is impaired. This is an accounting policy. Estimating fair value less cost to sell and value in use. This is an accounting estimate. And error. The company has estimated a discount rate of 10% but applied at 1%. It is an error. Okay. So this was on the Ind AS 8. I hope it is clear to each and every one of you. Please let me know if it is not clear to you guys. Please let me know. Please let me know if it is not clear to all of you. Please let me know if you have any question. Friends, do let me know if you have any question. Do you have any question? Do you have any question, or you don't have any question? Is it clear to all of you?
Yes, sir. It's absolutely clear.
Absolutely. This was a conceptual standard, right? This was a small standard, conceptual standard. So I have explained you each and every aspect with the example. I have shown you the annual report. So you can study, you can do all the just using these concept. You can cover all the ICAI study material question, right? It's more of a theoretical aspect. So you will be able to get a command on 100% basis on this particular standard. Friends, I hope you guys have understood it. It's 8:30 now. Let's have a 10 minutes break and we will start at 8:40 with new Ind AS, which is Ind AS 10. Okay? Ind AS 10.
Sir, sir, I need one clarity, sir. Sir, when the new Ind AS is introduced and issued, but not effective, whether we need to disclose anything on this our financial statement?
Yes. For example, if a new Ind AS is issued, but it will be applicable, effective from the future years, you just need to write just one disclosure you need to give: standard issued but not yet effective. This is a disclosure which is required in the financial statement, which says that wide MCA notification dash 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 while MCA notification XYZ date, this standard was issued, but it will be applicable from the next year, right? So this disclosure is required. And if the company has a material impact on the new standard, of course, the company has to provide that material impact also in the on 30th March 2019. So when the company was closing their financial statement for 31st March 19, they have disclosed that the new standard was the new standard on leases Ind AS 116 was notified on 30th March 2019. It is not applicable for the financial year ended 31st March 2019. It will be applicable from the 1920 financial year, and this standard has a material impact on us, and the company is into the process of assessing the impact on the new standard. Right? Is that clear?
Yes, sir. Clear, sir. I'm thinking why we need to disclose it.
Yeah. So thank you so much, and we'll meet at 8:40, okay, with the new standard Ind AS 10.
Okay, sir. Thank you, sir.
I hope my audio and video is perfectly fine. अशोक जी कोई
Yes, sir.
प्रॉब्लम तो नहीं है ना ऑडियो वीडियो में? ठीक है. So friends, the next standard, right? So whenever we think about financial statement, we are talking about financial statement on the reporting date. Yes or no? Financial statement for as at and for the year ended 31st March 2025. Balance sheet as at 31st March 2025. Okay. P&L for the year ended 31st March 2025. But friends, tell me one thing. Whether this financial statement which is for the year ended as at 31st March, is it prepared on 31st March only? Whether these
No, sir.
financial
After that.
statements are ready, whether these financial statements are prepared, these financial statements are audited on 31st March itself?
No, sir.
No. Of course, the audit happens after 31st March. Of course, the financial statement will be prepared, will be completed after 31st March, right? And if it is a listed company, okay, so then by when it is going to be approved? It is going to be approved within 60 days from the end of the financial year, right? Means for listed companies, the due date is 31st May. For 31st March, due date is 31st May. Okay, due date is 31st May. So friends, the information which pertains to 31st March will become public when the financial statement will be approved in the board meeting. Yes or no? I'm just taking an example of, let's say, Reliance Industries Limited. I'm just taking an example of Reliance. So the Reliance financial statement 31st March 25 number, balance sheet, performance, P&L, cash flow, they will become public in the month of May when the board of directors will approve the financial results, will approve the financial statements. Okay. So don't you think the information which you are getting on 31st May is a stale information which is related to the last year and related to the 31st March, related to the information as on 31st March for the year ended 31st March? Yes or no? Right? So let's say I'm taking an example. You are a shareholder of a company. Okay. When you got the financial statement for 31st March, okay. So this is the 31st March date. So when you got the financial statement for 31st March, on 31st May, you have seen that the inventory was 1000 crores. Inventory was 1000 crores. There was an inventory worth of 1000 crores. You are very happy. By looking at the inventory. Friends, just allow me a second. Okay, sorry. So the inventory was worth 1000 crores on 31st March. Okay. And you are getting this information on 31st May. But between this period, April, between this period, which is on 10th of April, there was a major fire broke out in the factory and godown of the company. Major fire of inventory, which was part of 1000 crores of inventory on 31st March. So this subsequently, after 10 days, 80% of the inventory got destroyed. 80% of the inventory. Friends, when you are getting this information on 31st of May, and this information pertains to 31st of March, do you think when you are enjoying, you are dancing, you are just celebrating that on 31st March you have the inventory worth 1000 crores? Is it a right occasion to celebrate, enjoy and dance? On 31st May, looking at the number on 31st March for 1000 crores, yes, the number is right, 1000 crores on 31st March, but you are getting this information on 31st May. Was that inventory as on 31st May, was that 1000 crore inventory is a 1000 crore of value? Or whether it got the realizable value of 1000 crore subsequently? Answer is no. Because after 31st March, a major event has happened which has destroyed the inventory worth of 800 crores. It's a post reporting date event. It's a post balance sheet date event, but it's a before publication of the financial statement event. It's a before approval of the financial statement event. So somebody needs to tell you this inventory was 1000 crore, but subsequently due to fire, it's after balance sheet date, there was a fire, and due to that fire, this 800 crores of inventory was destroyed. Okay. So this is known as events occurring after balance sheet date. This is known as events occurring after reporting date. This is known as events occurring after reporting date. What is the meaning of this? What is the meaning of this? For example, this is 31st March, end of the reporting period, 31st March 2025. This is the financial statement approved by the board of director, management, right? Which is 31st May 2025. So this period is known as events occurring after reporting period. After that, there is a AGM which is happening, right? Where the shareholders are also recommending these financial statements. There are 31st March to the approved in the board meeting, dated 10th May 2022. From reporting date to date of approval. From reporting date to date of approval. From doesn't matter. It could be anything. It could be anything, right? It could be favorable. It could be unfavorable. Both. Okay. Now that non-adjusting event. What is meant by adjusting event?
Even provide evidence of condition that expected at the end of the reporting period.
So friends, adjusting events means those events, although it had happened after, which is prepared for the reporting date. मतलब एडजस्टिंग का मतलब क्या है? एडजस्टिंग का मतलब है वो इवेंट हुआ तो रिपोर्टिंग डेट के बाद है, बट उसकी एडजस्टमेंट हमें रिपोर्टिंग डेट में लेनी पड़ेगी. This is known as an adjusting event. And what are those adjusting event? Adjusting event are those event where evidence of condition was available on the reporting date. Where evidence of condition was available on the reporting date. मतलब उसके होने की कंडीशन रिपोर्टिंग डेट पे अवेलेबल थी. फॉर एग्जाम्पल, द कंपनी हैज सोल्ड गुड्स ऑन क्रेडिट. द कंपनी हैज सोल्ड गुड्स ऑन क्रेडिट in the month of February. And the customer to whom, the debtor to whom the company has sold goods on credit, the debtor becomes bankrupt on 25th of March. The debtor becomes bankrupt on 25th of March. The company was not asking for money, or even if the company was asking for money, the debtor has not responded. The audit process was going on. And on 15th of April, during the audit, and on 15th of April, what has happened? On 15th of April, what has happened? On 15th of April, when the company circulated the balance confirmation, the company got to know that the customer has become bankrupt already on 25th of March. So friends, whether the evidence of condition of the bankruptcy of the customer was available or not available on 31st March, वो था या नहीं था? वो था. The only thing was the company was not aware. The only thing was company was not aware, but that customer has already become a bankrupt customer. Okay. So the information was available to the company after 31st March. So whether the adjustment is required or not required, the adjustment is required in the financial statement. You need to create a provision for bad debt. You need to create a provision for bad debt or bad debt in the 31st March books of account. The evidence of condition was available on the reporting date. The company has acquired a company. The company has acquired another company. The company has acquired another company. And this requires, the accounting requires a valuation. Okay. The company was in the process of getting the valuation done for the assets and liabilities. And it took the month of April. On 30th April, the company got the report for the valuation. The company got the valuation report on 30th of April. Friends, whether this valuation on 30th of April, whether this number has to be taken or not on 31st March for the purpose of accounting for business combination. Yes or no?
Yes, sir. We need to consider it, sir.
We need to consider the evidence of condition was available. The company has acquired another company. The valuation was started. Now the only thing is the numbers was confirmed. The valuation, the company got the valuation. What is a non-adjusting event? The non-adjusting event are those events which does not require adjustment in the financial statement. It only required disclosure. Evidence of condition arose after reporting date. Whether the evidence of condition has arisen after reporting date. So whether the evidence of condition of the fire was available on the reporting date. क्या कोई माचिस और kerosene oil रख के आया था? Whether somebody, yeah. So the fire which broke out due to fire was available on the reporting date.
No, sir. We are not the God to predict.
Yes. So no, that is why required to be done, my dear friends. Okay. And we discussed that the standard also requires that an entity should not prepare its financial statement on a going concern basis if events after the reporting period indicate that the going concern assumption is not appropriate. So friends, we'll also speak two special events occurring after reporting period. So event 5 in the board meeting dated 15th May 2025. The shareholders 30th June 2025. Please advise what is the events only up to 31st March or approval of the financial statement, not up to the AGM. So first we need to understood what is meant by events after reporting period. Number 2, these events that now
On demand.
in IFRS as well as in Ind AS, it becomes a current liability. But subsequently, before approval of the financial statement and after reporting date, the bank spoke to the bank. The company discussed with the bank. The company spoke to the bank and the bank agreed. Okay, I will not demand payment and you can go by the old terms. Bank has written a letter to the company and bank has agreed not to demand the payment. Friends, in IFRS treat this event as a non-adjusting event, and IFRS says that I will continue to present this as a current liability with a disclosure in the notes to accounts. In Ind AS, we says that no, there was a breach. The company was speaking to the bank, and before approval of the financial statement, this non-current become non-current only. I mean to say, the original nature of the loan was non-current, and even before approval of the financial statement, everybody has agreed and still it is non-current. So we said that we will treat this event as an adjusting event and we will take the cognizance of the fact which was arisen after reporting date. सो हमने क्या किया, हमने इसको एडजस्टिंग इवेंट ट्रीट कर लिया, हमने इसको एडजस्टिंग इवेंट ट्रीट किया, एंड वी हैव एडजस्टेड आवर फाइनेंशियल स्टेटमेंट एंड वी हैव shown this liability as a non-current liability. Okay, so this is known as a carve out. Is that clear to everyone? Yes or no?
Yes, sir.
Yes, sir.
Friends,
Yes, sir.
now let me discuss one of the important question from ICAI study material. Please hold on for a minute. Let me open that. Just a minute. Let's discuss this question. I hope this study material is visible to all of you.
Yes, sir.
On 18th May 2002, the management of an entity approved financial statement for issue to its supervisory board. The supervisory board is made up of solely of non-executives and may include representative of employees and other outside interests. So on 18th May 2002, the management means board of directors approved financial statement for issue to its supervisory board. और सुपरवाइजरी बोर्ड में कौन था, कुछ नॉन एग्जीक्यूटिव थे, और कौन था, कुछ एम्प्लॉय यूनियन के रिप्रेजेंटेटिव थे, और कुछ बाहर के लोग जो इंटरेस्टेड हैं, फॉर एग्जांपल द बोरोवर, द लेंडर, नॉट बोरोवर, द लेंडर. सो दीज वर इन द बोर्ड ऑफ द सुपरवाइजरी बोर्ड, जो सुपरवाइज कर रहे हैं. The supervisory board approves the financial statement on 26th May 2002, right? So supervisory board, employee representative, trade union representative, employee union representative. So all these which are consisting supervisory board, they are approving the financials on 26th May. The board of directors have issued on 18th May. The financial statement are made available to shareholder on 1st of June. Another AGM, right? The shareholder approved the financial statement at their AGM on 15th of July. The financial statement are made available on 1st of June means आपको पता है ना, पहले एनुअल रिपोर्ट छप जाती है, एनुअल रिपोर्ट चली जाती है. You as a shareholder got the annual report in advance. Okay, and then shareholder are approving the financial statement at AGM on 15th of July. And the financial statement are then filed with the regulatory body on 17th of July. So many dates are given. In this example. Tell me, what is the date up to which the events after reporting period has to be taken into consideration? What is the date?
18th
Date of
May.
supervisory board. Sorry.
18th May, sir. Since the once it is approved by the board of directors, that is a final. Subsequent approval is not needed.
Yes. So subsequent approval is not needed. It is just a formality. Okay. So 18th May is the date up to which the events after reporting period needs to be considered. So events up to 18th May has to be considered for the purpose of events after reporting period. Right? Is that clear? Is that clear?
Yes, sir.
So
Yes, sir.
we discussed this, and so friends, let me tell you one of the question, whether events under the yes, ABC Limited prepared interim financial reports. This standard is also applicable to interim financial reporting also. So ABC Limited prepared interim financial report for 30th June 2001 quarter, first quarter. The interim financial report was approved for issue by the board of directors on 15th of July, 15 days after 30th June. Whether events occurring between end of the interim financial report means 30th June, and date of approval by the board of directors, that is 1st July to 15th July, which provide evidence of condition existing at the end of the interim reporting period shall be adjusted in the interim financial report ending 30th June 2001. So to cut a long story short, first question. In this case, the company is publishing the interim financial report, the interim accounts for 30th June on 15th of July. Means this is getting approved on 15th of July. So my question to all of you in this case, whether 1st July to 15th July will be considered as an interim period or not?
Yes, sir.
Wrong. So I was wrong.
Not.
It was not interim period, events occurring after reporting date.
Yes, sir. I mean that only, sir.
Yeah. So whether it is events after balance sheet date period, answer is yes. If it is events after balance sheet date period, then it could be adjusting event, it could be unadjusting event. And when the evidence of condition was available on 30th June, and it is a subsequent event which is happening before 15 July, whether it requires adjustment or not. It requires adjustment. It requires adjustment. Correct? It requires adjustment. Okay. Fine. Clear? Very good. Yes.
Clear.
Friends, yes. Illustration number 3. The board of director of ABC Limited approved the financial statement for the reporting period 2001-2 for issue on 15th June 2002. What is the reporting year? What is the reporting year?
21-22.
Reporting year is 1-2. 1-2 is the reporting period. And when it is getting approved? 15th June. Means after 2.5 months. The management of ABC Limited discovered a major fraud and decided to reopen the books of accounts. So these financial statements were approved on 15th of June. Now they found a major fraud and they wanted to reopen the books of accounts. The financial statement was subsequently approved by the board of directors on 30th June after correcting those frauds. After taking the impact of the correction of the frauds in the financial statement, the management has reopened the books of accounts and subsequently approved by the board of directors on 30th June. What is the date of approval for issue as per Ind AS 10 in this case? So in this case, what is the date of approval? Because events occurring after reporting period is from the reporting period to date of approval. What is the date of approval? Is it 15th June or is it 30th June?
Sir, in this case, it is 30th June because we have identified the fraud and it is rectified, and we have to consider that 30th June as a reporting period.
Anyone else? Anyone other than Swaminathan? Anyone else? Anyone?
Yes, sir. I also agree with Swaminathan. It's like since we would be considering the last final approval date.
You will be considering the last final approval date. You're absolutely right. And Swaminathan, you're absolutely right. In this case, the last final approval date will be considered as an approval date, and the period from 1st April to 30th June will be considered as events occurring after balance sheet period, right? And for this period, you need to see whether it is an adjusting event or unadjusting event, right? If the evidence of condition was available on the reporting date, it was an adjusting event. If evidence of condition was not available on the reporting date, it is a non-adjusting event. Okay, it is a non-adjusting event. Clear? Is that clear?
Yes, sir. The reason is that once it is corrected, the auditor's responsibility to check the audit procedure. He has to verify that whether it is rightly, appropriately accounted or not to get the audit evidence.
Yes. So events which provide evidence of condition existing on the reporting date, entity should adjust the amount recognized in the financial statement to reflect the adjusting event after the reporting period. It can be favorable, it can be unfavorable, right? Example, settlement after the reporting period of a court case that confirms that the entity had a present obligation at the end of the reporting period. So while the outcome of the court case came after the reporting date. But even on the reporting date, there was a present obligation which was arising due to the past events. There was a present obligation, and the council was aware that we will lose the case. Okay. Receipt of information after reporting period, indicating that an asset was impaired at the end of the reporting period, or that the amount of a previously recognized impairment loss for that asset needs to be adjusted, for example, bankruptcy of the customer. Determination after the reporting period of cost of assets or the proceeds from assets sold before the end of the reporting period. You want a chair. Sanjay need a chair. He went to his friend. His friend has a furniture shop. So he went on 31st March to bought the chair from his friend's shop. So he took the chair and he asked, what is the price? His friend told, "Arey, not to worry. We will do it. We'll kar lenge isko. Okay. We'll discuss later on." His friend hasn't told him a price. Okay. He brought the chair in his office, right? He put the chair, he started using the chair. After 15 days, after doing a lot of follow-ups, his friend has sent an invoice of 5,000 rupees. Right. So the cost of the asset was determined after the reporting period. Of course, in that case, you will capitalize this chair on 31st March with 5,000 rupees. Okay. The determination after the reporting period for the amount of profit sharing or bonus payments, if the entity has a present legal or constructive obligation at the end of the reporting period. Many companies are paying bonuses to the employees, and these bonuses are on the basis of the final profit. Many companies are distributing the profit to their employees. They are giving the performance related pay on the basis of performance of the company. So like in my old company in ILFS, where I was working 10 years back, they have a policy of distributing 10% of the profit to the employees. Now tell me, for getting a 10% of the number, what is the number you have to derive first?
We have to arrive the profits.
The number of profit. अगर profit का number नहीं पता होगा तो 10% of the profit कैसे पता होगा, right? And whether this profit is available on 31st March or this profit will be available after 31st March.
After audit only we will know exact amount of the profit.
After audit only we will be able to know the amount of the profit. And if you will know the amount of profit after 31st March, so this provision for bonus, provision for distribution, provision for bonus, provision for profit sharing. So when you will be able to determine? You will be able to determine after
Audit.
31st March. But do you have a present obligation on the reporting date that whatever profit you will make for that year, 10% you will distribute? Either a contractual obligation or a constructive obligation. Do you have that obligation? Answer is yes. You have that obligation. So friends, this is also an adjusting event. तो ये सारी की सारी कंपनीज जो भी प्रॉफिट बाद में जो भी प्रॉफिट जिनका निकलता है उसके ऊपर ये बोनस का पीरियड. Entity should not adjust the amount recognized in the financial statement to reflect adjusting event after the reporting period. Right? It can be favorable, it can be unfavorable. It can be both favorable as well as unfavorable. Example, major business combination after the reporting period or disposal of the major subsidiary after the reporting period. In this case, you have to only disclose. You are not required to adjust your 31st March financial statement. That subsidiary was your subsidiary. That subsidiary was your subsidiary up to 31st March. You haven't acquired the business up to 31st March. Doesn't matter the talks was going on, but again, it will be a non-adjusting event which requires disclosure. You cannot adjust your financial statement. करेंगे क्या आप पहले 31st मार्च को डिस्पोजल कर दोगे सब्सिडरी का, जबकि आपके पास आपने उसका डिस्पोजल 15th अप्रैल को किया है. You have all the right in participating the profits of that subsidiary up to 15th April. No, you will, if you are disposing your subsidiary after reporting date, so it will be a non-adjusting event. You are only required to provide the disclosure. so that the user will be able to understand the numbers of the subsidiary which are consolidated and which you are looking at. You will not find those numbers in the subsequent period. Why? Because this has already been discontinued, disposed of before approval of the financial statement. Announcing a plan to discontinue an operation. Again, it's a non-adjusting event. Destruction of a major production plant by a fire after the reporting period. Again, a non-adjusting event. Abnormally large changes after the reporting period in asset prices or foreign exchange rates. Again, this is a non-adjusting event. Changes in tax rates or tax laws enacted or announced after the reporting period. Right? It's a non-adjusting event. Commencing major litigation arising solely out of event that occurred after the reporting period. So, after reporting period, the company has sold the goods to the customer. After reporting period, the company has sold the goods to the customer. The good was faulty. The goods was faulty. The customer has filed a case in the consumer court. The consumer court announced the compensation within 5 days. Friends, is it an adjusting event? Whether that court case was there on the reporting date? Yes or no?
No, sir, but the faulty product, what we consumed, it was before to the reporting date. Definitely, it is adjusting.
It was after the reporting date, Saminathan. I told na the goods were sold after the reporting date. So
okay, then it is not.
You are
then it is
preparing.
Not.
You are preparing or auditing your financial statement in the month of April 2025. In the month of April, the company has sold the goods which were faulty. The customer, in the month of April, the customer went to the consumer court. In the month of April, consumer court announced the compensation. So in this case, all these events are non-adjusting events. But what happened? If the faulty goods were sold before 31st March, the consumer has filed the court case and the outcome of the court case came in the month of April. Then
it is adjusting event.
Then it become an adjusting event. Okay. Right? Okay. Major purchases of assets or classification. Major purchases of assets or classification of asset as held for sale in accordance with Ind AS 105 or discontinued operation. Major purchase of asset, discontinuing operation, non-current asset held for sale. These are also treated as a non-adjusting event. Is that clear? Is that clear to everyone? Yes or no?
Yes. Yes, sir. Yes.
I hope my presentation is visible to everyone. I hope.
Yes, sir. There is a special event.
Yeah.
Slide of a special event is visible.
Yeah. Let's discuss illustration number 4 of ICAI study material. A case is going on between ABC Limited and GST Department on claiming some exemption for the year 2001-2002. The court issued the order on 15th April 2002 and rejected the claim of the company. The case was going on the reporting date. The case was going on. What happened after that?
So
the court issued the order.
Rejected.
And rejected the claim of the company, means the court has decided against the company. Accordingly, the company is liable to pay additional tax. Okay. The financial statement of the company for the year 1-2 have been approved on 15th May 2002. So what is the event after reporting period? What is the events after balance sheet date period?
It's a 15th May, sir.
Outcome of the court order.
From 1st April to up to 15th May. And this court order came on 15th of April 2002. Should the company account for such tax in the year 1-2 or should it account for the same in year 2-3? Is it an adjusting event or non-adjusting event?
Adjusting event.
It is adjusting event, sir.
It's an adjusting event. The court case was going on. It's an event after the reporting period becomes an adjusting event if it provide evidence of condition existing at the end of the reporting period. Here, this condition is satisfied. Why? Court order received after the reporting period but before the financial statement are approved provide evidence of the liability existing on the end of the reporting period. Therefore, the event will be considered as an adjusting event and accordingly the amount will be adjusted in the financial statement for the year 2001-2. Okay. Let's discuss one more example. Just a minute. Yes, quickly. In the plant of PQR Limited, there was a fire on 10th May 2001 in which the entire plant was damaged and the loss of 40 lakh is estimated. The claim with the insurance company has been filed and a recovery of 27 lakh is expected. The financial statement for the year ended 31st March 2001 were approved by the board of directors on 12th of June. So reporting date is 31st March. Date of approval is 12th June. Events occurring after reporting period is 1st April to 12th June. And this event happened. This fire damaged this plant on 10th May. How should it be disclosed? Tell me what is the treatment? What is the treatment of this fire?
This is a
Sir,
non-adjusting.
it will be, sir, non-adjusting.
Friends, in such kind of situation, friends, first of all, you need to look at whether the impact of the fire is an impact on the going concern of the business. If the impact is on the going concern of the business, then will it be adjusting event or will it be non-adjusting event?
Then it will be adjusting event, sir.
Yes, if the going concern has been impacted, this is a special treatment. This is a special exception to the non-adjusting event treatment. This is an exception. And what is the exception? If the going concern has impacted, doesn't matter. It is after the reporting date, the fire has broke out in the plant and the plant has completely damaged. Now the company is no longer able to produce. The company is into big losses. The company is not very much sure about the future of the company. In this case, going concern is impacted. While this after reporting date fire is a non-adjusting event, but since the going concern has been impacted, whether this will be treated as a non-adjusting or adjusting.
Yeah, if it is a going concern is inappropriate, it is impacting huge, then definitely it will be a adjusting event.
It will be an adjusting event, means you will prepare your financial statement on some other basis, not on the going concern basis, right? You have to take the impact of these losses, right? You have to prepare your financial statement on a liquidation basis or some other basis, but not on a going concern basis. Is that clear?
Yes, sir. But in this case, the 27 lakhs, in this case, the 27 lakhs, the insurance company is filed. So there are probably they're expecting the amount. See, since the going concern is appropriate in this case, we can put it as a non-adjusting and we can disclose the matter.
Of course, yes. So what is written in the Institute study material? In the instant case, since fire took place after the end of the reporting period, it is a non-adjusting event. However, in accordance with para number, you are not required to write para number. Don't write wrong para number in the exam. If you remember para number, please write. If not, please don't write. In accordance with Ind AS 10, disclosures regarding material non-adjusting event should be made in the financial statement. That is the nature of the event and expected financial effect of the same. So what is the disclosure for non-adjusting event? The nature of the event and the expected financial impact. with regard to going concern basis followed for preparation of financial statement, the company needs to determine whether it is appropriate to prepare the financial statement on a going concern basis, since there is only one plant which has been damaged due to fire. If the effect of deterioration in operating results and financial position is so pervasive that management determines after the reporting period, either it intends to liquidate the entity or to seize the business, or it has no alternative remain except to seize the business, except to shut down the business. In that case, preparation of financial statement for the financial year 001 on a going concern assumption may not be appropriate. In that case, the financial statement may have to prepared on a basis other than going concern. It will become a adjusting event. It will become an adjusting event. However, if the going concern assumption is considered to be appropriate even after the fire, no adjustment is required in the financial statement for the year ended 31st March 2001. Is that clear to everyone?
Sir, what is mean by other than going concern, sir?
Other than going concern means liquidation basis. गोइंग कंसर्न बेसिस मतलब आप गोइंग कंसर्न बेसिस में क्या करते हो? आप अक्रूवल बेसिस पे भी तो अपने फाइनेंशियल स्टेटमेंट बनाते हो ना?
Yes,
In
sir.
case of going concern, you are preparing your financial statement on accrual basis. But when your going concern is impacted, will you prepare your financial statement on accrual basis? आपको पता ही
No,
नहीं है
sir.
कि
It
आप
will
एक
be
साल
on
के बाद
cash
ऑपरेट कर पाओगे. Yes. So it will be on realizable basis. So friends, these are the two special events where the exception has been given. The first one is going concern, which I have discussed with the help of an example illustration. An entity shall not prepare its financial statement on a going concern basis if management determines after the reporting period either it intends to liquidate the entity or to cease trading, or that it has no realistic alternative but to do so. For example, on 15th of April, everything was going great. Everything was going great. But on 15th of April, the board of directors have announced that they want to shut down the business of the company in the next 6 months. While it is a non-adjusting event, but is it impacting the going concern or not?
Yes,
Yeah,
sir.
definitely impact the going concern because plant is going to shut down.
Yes, because looking at the reporting date, 31st March, you need to look at from the going concern perspective. The first thing is whether you will be able to continue and operate in the foreseeable future. Okay, in the foreseeable future. What is a foreseeable future? 12 months from the reporting date. And of course, you are very much sure you have announced that you are going to shut down your business within 12 months. So it is a adjusting event. Since it has an impact on the going concern, it become your adjusting event. Dividend. Friends, you understood the meaning of dividend? Interim dividend, final dividend. You understood dividend? Yes or no?
Yes, sir. Yes, sir.
Anyone who does not understood dividend? Not to worry. You can just write on the chat box. I will not take your name, but I will explain. Dividend is a distribution from the profits of the company to the shareholders. Okay. This is the meaning of dividend. The company is giving bonus to the employees from the profit. So how the company will provide a return to the shareholder? In the form of dividend. In the form of dividend, right? So distribution of the profit to the shareholder is known as a dividend. Distribution of the profit to the employee is known as a bonus. Now, for example, the company is having a profit in the financial year 24-25. So the 24-25 financial statements are prepared and audited in the month of April and May. In the month of May 2025, the financial statements are approved and the dividend was also declared in the board meeting in which the financial statements have been approved. And this dividend pertains to financial year 24-25. this dividend is declared out of the profit of 24-25. Now my question to all of you is whether this dividend needs to be adjusted in the financial statement of 24-25, or this dividend needs to be adjusted, or this dividend needs to be accounted for in the next financial year, which is 25-26. What is your view?
It is a non-adjusting item, sir. We will record in the subsequent year when it is a declared and approved. Only the period only we will account it.
So first of all, the question is it adjusting event or is it a non-adjusting event? First of all,
Non-adjusting event, sir. Non-adjusting event.
whether the evidence of condition of dividend was lying on the reporting date? Answer
No,
is
sir.
no. Because
sir.
there is no contractual obligation. There is no contractual obligation. Number one. Number two, when the board will declare the dividend, when the board will approve the dividend, then only this dividend will become payable, right? Or when the shareholders will approve, only then it becomes payable. So the evidence of condition was not lying on the reporting date. That is number one. Number two, let's say this dividend was declared in the month of May. It approved in the month of May. And now this dividend is payable to the shareholders. Who are the shareholders at the time of book closure, right? So there is a book closure dates, record date. Have you heard about record date? So whenever the company has to pay the dividend, the company will pay the dividend to those shareholders who are the shareholder of the company on a particular cutoff date, right? Which is after declaration of dividend. Let's say Reliance has declared dividend on the month of May. I was the shareholder on 31st March. I was the shareholder on 31st March. I have sold my shares on 30th of April. I have sold my shares. Now, Chitra has purchased those shares. I have sold shares. Chitra has purchased shares. So now Reliance has declared dividend on 31st of May. Chitra is shareholder on 31st May. So who will get the share? Whether should I get the share? Should I get the dividend because I was holding share up to 31st March? Or Chitra will get the dividend because she is holding the share on the record date?
Chitra will get the dividend, sir.
Yes. So the point is, this dividend is nothing to do with the evidence on the reporting date. There was no evidence of condition available on the reporting date, right? This dividend is a unpublished price sensitive information. This dividend becomes payable when the director has declared. There was no contractual obligation. So standard says that it's a special case. Standard says that doesn't matter, dividend pertains from the last year profit. Dividend pertains from the past profit, right? Doesn't matter. But this dividend is a kind of an item which is a non-adjusting event. Only disclosure will be required and dividend liability has to be recorded in the year in which it has been approved, right? So dividend declared after the end of the reporting period are not recognized as these are non-adjusting events. Is that clear to everyone? Is this clear to everyone, friends? Yes or no? Is this clear to everyone?
Yes, sir. Dividend is not like that loan interest repayment. It's not like that the preference dividend.
Yes.
The ordinary dividend is not like that. Hence, it is a non-adjusting event. Yeah.
Yes. So let's discuss this question. ABC Limited declares the dividend on 15th of July. ABC Limited declares the dividend on 15th of July. As a result of the year 2001-2, as well as quarter ended 30th June 2002 are better than expected. The financial statement of the company are approved on 20th of July 2002 for the financial year ended 31st March 2002. So what is the date of approval? Date of approval is 20th July. What is the reporting date? 31st March. What is the event occurring after the reporting period? 1st April to 20th of July. When the company has declared the dividend? 15th of July. Okay. So friends, will this dividend be accounted for in the financial year 2-3 in which it is declared, or it will be accounted for in the year 1-2 from the profits, out of the profits to which it is declared? So is it 1-2 or is it 2-3 where this dividend is recorded?
Yeah, it will record it in 2 and 3, sir. For 1, 2, they will disclose it.
Others, are you agree with Saminathan or not agree? Please write on the chat box or please call out. Do you agree or you not agree? You agree or disagree? I need the answer, guys. Please
Agree.
agree.
Yes.
What about others? Agree or disagree?
Yes, sir. Agree. Yeah.
Yes, he is right. He is right. So this dividend has to be recorded in the year in which it is declared, right? This is nothing called as adjusting event because evidence of condition was not available on the reporting date. Okay, so it has to be recorded in 2-3, but the disclosure has to be given in 1-2. Okay. Now, friends, what are the disclosure which is required? Date of approval of financial statement is required to be given. That the financial statement of XYZ Limited has been approved in the board meeting dated so and so by the board of director. So date of approval of issue is required to be given. Date of approval of issue is required to be given in the notes to accounts, right? It is required to be given in the notes to accounts. Is that clear? Is that clear?
Yes, sir.
Yes
And
or no?
who approved also we need to give.
And who approved, that is also required to be given. First of all, date of approval of issue and who approved those financial statement, it is also required to be given, right? That so and so director in their board meeting dated so and so, they have approved the financial statement. Okay. Yes. So friends, then what is required to be given? What is required to be given then? So non-adjusting events are also required to be disclosed. The nature of non-adjusting event and the impact of the non-adjusting event, right? And for all those material category of non-adjusting event, nature of event and the estimate of the financial impact. And how this is going to be disclosed? So let me show you the extract from the JSW Steel Limited, a big listed companies, right? And what they have disclosed, subsequent events. Subsequent events means events after balance sheet date but before approval of the financial statement. On 21st May 2021 means after reporting date but before approval, the board of director recommended a final dividend of 6.5 rupees per share to be paid to the shareholder for the financial year 2021, this old financial year, which is subject to approval by the shareholder at AGM to be held on 21st July. If approved, the dividend would result in cash outflow of 1571 crores. What they have given? They have given the nature of the non-adjusting event and the impact of the non-adjusting event. Yes or no? Yes?
Right, sir. Amount.
They have given this amount also. And what they have given, the second subsequent event they have given. On 13th April 2021, JSW Steel Italy, they have a company in Italy also, subsidiary of JSW Steel Limited. They have a wholly owned subsidiary of the company completed the acquisition of remaining this much of equity share, representing 30% equity share capital of GSI Lucchini SPA for a consideration of 1 million euro. Consequent to this company become a wholly owned subsidiary of the company, right? Friends, what they have disclosed? They have disclosed a major business combination happened after the reporting date. You remember this was a non-adjusting event, right? So friends, this disclosure, I have shown you the disclosure also. So friends, we talked about what event is considered as a events occurring after balance sheet date. What is the period which is covered, right? So the period is from the reporting date, end of the reporting date to the date of approval of the financial statement. When there is a discovery of fraud or error, the final approval will become the date of approval, right? For the purpose of events occurring after reporting date. Events could be adjusting, could be non-adjusting. If it is an adjusting event, right, it has to be adjusted in the financial statement. Adjusting event means those events whose evidence of condition was available on the reporting date. Non-adjusting event means those events whose evidence of condition was not available on the reporting date. आग लग गई, किसी ने माचिस नहीं रखी थी, okay, reporting date पे. So friends, it could be favorable, it could be unfavorable. In case of non-adjusting event, the nature of the event and the financial impact of the event, estimated financial impact of the event has to be disclosed. There were two special transactions going concern. If due to non-adjusting event, the going concern is impacted, it will become an adjusting event. And dividend, so dividend which is declared after the reporting period, out of the profit from the last financial year, doesn't matter. It will be treated as a non-adjusting event. Okay. And I have shown you the disclosure also. Friends, now quickly you need to answer this. Right? We have some question. You need to answer this. Tell me, which of the following will be treated as an adjusting or non-adjusting event? Tell me. So, which of the following events are going to be adjusting and which are non-adjusting? Reporting date is 31st March. Significant disposal of major subsidiary after balance sheet date took place in May. The gain on disposal was 20 million. Is it adjusting or is it non-adjusting? It is happening in May. The significant disposal.
Non-adjusting event.
So it's a non-adjusting event, sir.
It's a non-adjusting event. Management board took decision on 30th March to dispose significant part of business and announced its plan on 28th of May. Adjusting, non-adjusting.
Yeah, it is an adjusting event.
It's adjusting event, sir. As per Ind AS 37 also it's saying like this. If it is announced before the reporting period, it is a adjusting event.
It is a non-adjusting event because the board has took the decision but not announced the decision. Ind AS 37 says that if the decision of restructuring, if the decision of disposal, discontinuation, restructuring has been announced before the end of the reporting period, right? Announced means it has been announced to the impacted parties, then it will become a constructive obligation, right? In this case, while the board has took the decision, but this decision doesn't become public, it has not announced. And when it has announced after the reporting date. And hence it becomes non-adjusting. Oh, sorry. The company had marketable investment, the value of which deteriorated as a result of global crisis, which started in May.
Non-adjusting. Non-adjusting.
As of 15th April, a major fire took place, point number 4, and significant portion of asset is now impaired. It caused a significant disruption in daily activities and a loss of LC currency, 12 million of assets in book value terms. The company will need to borrow new funds to restore its operating capacity.
Sir, it's a non-adjusting, sir. Going concern is not affected because LC, the 12 million is resumed.
Guys.
Sir, it will be, sir, adjusting.
Why adjusting?
Because, sir, company is unable to, it's impacting its going concern. It have to borrow money to new funds to restore it normal operating.
So going concern does not mean having a losses, right? It does not mean. Even all these startups are into big losses, but there are investors who are funding. There are the banker who are funding. So if the company can borrow the money and the company can again rebuild the business, regain the business, then going concern is not impacted, right? So in this case, it will be non-adjusting, but you will get your answer in the next point. A major fire post-reporting date destroyed most of the company's assets. All production lines no longer operative. To date, the company could not borrow new funds to restore its operating capacity. The director have not yet decided about the future of the company. Friends, adjusting, non-adjusting.
It will be
Adjusting event.
Now it will be adjusting event because going concern is impacted.
Yes, sir.
Next, after balance sheet date, but before the approval of the financial statement, as a result of the court decision, the company had to pay a compensation to one of its customer for faulty operation of the product, which was sold to that customer in December.
Sir, it is adjusting event.
Adjusting.
Yeah, sold
Adjusting.
before the reporting period.
It is an adjusting event. Last, one of the employee died as a result of food poisoning during the work sometimes in April. On 28th of June, the court decided that the company was liable of the food poisoning and awarded 1 million in compensation to the widow.
Non-adjusting event.
This is
Why?
a non-adjusting event, sir.
Why?
Sir, we will not accept the employee will die.
Event
It is
happened
not.
in April itself.
Yes, because this event has occurred after reporting date, after balance sheet date. The death has occurred in the month of April, which is after March. If the death would have occurred in the month of March, right, and the court case was going on, and this decision came before approval of the financial statement, it become an adjusting event. So this is a non-adjusting event, right? So friends, I hope you have enjoyed this exercise. Yes or no?
Yes.
Yes.
Yes, sir.
Yes, sir. You have given a lot of explanation and illustrative examples, sir.
And we have covered around 7-8 illustration from ICAI Board of Study Material, a lot of example from my own examples, right? Then this last test, okay? And the difference between Ind AS and AS, in accounting standard, it is AS4. And in accounting standard, the biggest difference is, like this non-adjusting event is required to be disclosed in financial statement, notes to accounts in Ind AS. In accounting standard, this is only required in director's report. It is not required in financial statement, right? So this is one of the biggest difference. And friends, the last one is thank you so much. We have covered today two standard Ind AS 8 and Ind AS 10, right, in detail. Friends, now you have to solve each and every question from ICAI study material. If you found any problem, any challenges, you can write me on cacs@alokgarg@gmail.com. Saminathan, I got your mail. I will respond you tomorrow. I haven't got the time. Okay. I will revert you tomorrow. One of the student has also written me a mail for some doubt. I will also revert tomorrow, second half. Okay. Between 3 to 4. Okay. Yes.
Right, sir. Thank you, sir.
So friends, please solve all the questions, all the illustration, cover all the examples from ICAI study material on Ind AS 1, Ind AS 7, Ind AS 8, Ind AS 10. So now you have complete Saturday, Sunday, Monday. We'll have a class on Tuesday. So you'll have 3 days. So please solve all the questions, right? This way you will have a full command on these 4 standards. Thank you so much. Have a great day. Enjoy your weekend. Thank you so much. Bye-bye.
Thank you so much,
Thank you
sir.
so much, sir. Have a wonderful day.
Thank you.
Thank you, sir.
Thank you.
Ashok ji, session is over. Thank you.